We are looking directly at the Q1 2026 earnings call transcript for Constellation Energy Corporation, ticker symbol CEG.
Right, led by CEO Joe Dominguez and CFO Shane Smith.
Exactly. And, this is not just some backward-looking review of corporate financials. For everyone listening, you are looking at the exact intersection of the massive artificial intelligence boom, the increasing frequency of extreme weather events, and frankly, the literal physical future of the American power grid.
Oh, absolutely. Which makes this specific source material essentially a blueprint for the next decade of domestic infrastructure.
Yep.
I mean, we have the nation's largest producer of carbon-free energy managing just unprecedented explosive demand growth.
Yeah.
And they're doing this while simultaneously navigating some of the most complex regulatory bottlenecks we've seen since, deregulation.
Totally. So our mission today for this deep dive is to break down how management is maneuvering through this landscape, and specifically what their capital allocation strategy means for the tech sector's growth and the broader electricity markets that affect you and your own utility bill.
Yeah, separating the Wall Street jargon from the real world impact.
Okay, let's unpack this, because before we get into the futuristic AI data center loads and, the forward pricing curves for the late 2020s, we have to ground ourselves in the immediate operational reality of the first quarter.
We do, because that reality was, it was defined by extreme duress on the physical grid, paired with surprisingly robust financial execution.
Right, the headline numbers. Management reported GAAP earnings of $4.49 per share.
Yeah.
But looking past the mark-to-market noise on forward hedges, the adjusted operating earnings came in at $2.74 per share.
Which is huge.
It is. That is a massive 60-cent jump from the first quarter of 2025.
It's a phenomenal beat. And, they confidently affirmed their full-year adjusted earnings guidance of $11 to $12 per share.
Yeah, they didn't back down from that at all.
Not at all. And when you look at the mechanics driving that jump, CFO Shane Smith highlighted the sheer accretion of the Calpine acquisition.
Right.
That integration is currently modeling out to add roughly $2 per share of accretion for the full year.
$2 a share just from the acquisition.
Exactly.
Yeah.
And when you stack that Calpine retail margin on top of the significantly higher cleared capacity prices we're seeing in the PJM market, you get a highly leveraged upside to their growth margins.
Okay, so the financials look pristine on the page, but I was really struck by the dissonance between the balance sheet and the actual physical operating environment they described on the call.
Oh, for sure. The major hurdle they had to clear this quarter was Winter Storm Fern.
Right, and an extended deep freeze event like Fern fundamentally alters the cost to serve dynamics.
It changes everything.
It does. I mean, the grid essentially collapsed in specific regional pockets. Constellation found themselves forced to deploy their own operating reserves just to support overarching system reliability, which inherently drove up their cost to serve load across their entire retail book.
And that's the paradox of the independent power producer model, right? Yeah. Your highest potential revenue realization occurs at the exact moment. Your operational friction and, your risk of physical failure are at their absolute maximum.
Right. I always compare it to running a hospital during a massive blizzard.
Oh, that's a good way to look at it.
Right.
Oh.
Because revenue might go up because every single bed is full and demand is through the roof.
Yeah.
But the physical cost and the sheer stress of just keeping the lights on and the staff moving are astronomical. So if the wholesale power markets use nodal pricing, that spikes during a grid emergency.
Which it absolutely does.
Right. But if your plants trip offline and you have to procure replacement power at those insanely inflated index prices just to meet your day-ahead commitments,
then a grid collapse is actually a massive financial liability, not a windfall.
Exactly. Which makes their actual physical plant performance the linchpin of the entire quarter. I mean, financial engineering and hedging strategies instantly evaporate if your turbines freeze.
They mean nothing.
Right. So looking at the operational data, how did they hold up? Their nuclear fleet generated 40 million megawatt hours of firm energy with a 92.3% capacity factor.
Yeah, and I know what you're thinking.
Well, I initially looked at that 92% and thought, that seems slightly depressed for baseload nuclear.
It does on paper, but Shane Smith specifically noted this figure absorbed an unusually high concentration of planned refueling outage days for first quarter.
Ah, okay.
Yeah, so when you adjust for the refueling cycle, the underlying asset availability is actually exceptionally tight.
Got it.
But the metric that truly stress tests the fleet during a weather crisis like Winter Storm Fern isn't the baseload nuclear.
Right, it's the thermal and natural gas generation.
Exactly. Their combined cycle and cogeneration fleet produced 23 million megawatt hours. And the headline capacity factor for that thermal fleet was only 47.1%.
Yeah, I noticed that 47.1% figure, and I think it highlights a critical misunderstanding a lot of people have about dispatchable generation.
How so?
Well, a low capacity factor on a gas peaker or a combined cycle plant isn't an indicator of poor performance. I mean, these assets are entirely beholden to the dispatch signals from the independent system operators.
Right. They sit idle by design.
Exactly. They wait for the base load to fall short or for intermittent renewables like wind and solar to drop off.
Yeah.
So the metric that actually dictates their performance isn't capacity factor, it's the forced outage factor.
And Constellation posted a forced outage factor of just 5.1% across that entire thermal fleet.
Which is incredible.
It really is. I mean, think of a gas turbine as a massive, hyper-engineered jet engine connected to the ground,
Right.
forcing it to sit in sub-freezing temperatures, entirely dormant, and then suddenly demanding it ramp up to maximum thermal output in a matter of minutes. That introduces extreme mechanical stress.
Yeah, metal expanding, ice, everything.
Exactly. So maintaining a 5.1% failure rate under those specific conditions means that when the regional transmission organizations sent the emergency start signals, Constellation's iron actually spun up and synchronized to the grid nearly 95% of the time.
Wow. And that reliability premium is really the bedrock for their forward strategy.
It has to be.
Because surviving a sporadic weather shock is one thing, but Constellation is actively re-architecting the company to handle a massive, permanent and structural shock to the grid.
The tech industry.
The hyperscaler data center build-out. I mean, Joe Dominguez laid out figures on compute spending that are frankly hard to even contextualize.
Yeah, the numbers are wild.
He noted that projected compute spending for 2026 is tracking nearly 75% higher than last year's figures. 75%.
What's fascinating here is the physical manifestation of that capital expenditure. We aren't just talking about buying silicon, we are talking about securing the underlying energy necessary to train these foundational AI models.
Right, because you can't run a data center on hopes and dreams.
No, you can't. Hyperscalers require 2047 high nines firm power. And the traditional model of requesting a massive load interconnection from the public grid and waiting 5 to 7 years for transmission upgrades is just no longer viable for their deployment schedules.
It's too slow.
Way too slow. So this is driving Constellation's aggressive push into what they call powered land agreements.
The Freestone deal is the perfect test case for this, right?
Yep.
Constellation secured approval from the Public Utility Commission of Texas, the PUCT, for a net metering agreement associated with a powered land deal with Cyrus One at the Freestone Energy Center.
And they are moving fast.
Yeah, they are already putting steel into the ground for the substation, targeting energization by the fourth quarter of this year. Bypassing the macro grid entirely to co-locate the load right at the generation source fundamentally changes the unit economics of the power purchase agreement.
It alters the economics because it strips out the non-bypassable transmission and distribution charges that historically plague large industrial loads.
It's like building a massive factory directly on top of a coal mine in the 1800s to avoid paying for train transport.
That is exactly what it is.
We are seeing a return to hyper-localized power consumption, just with, clean energy and server racks instead of steam engines.
Right. You essentially treat the data center as a localized, highly predictable parasitic draw on the power plant. By netting the load behind the meter, Constellation can monetize the megawatts immediately upon generation without subjecting the power to the congestion pricing and line losses of the broader ERCOT transmission topology.
That's incredibly efficient.
And Freestone is just the vanguard. I mean, Dominguez pointed out they're sitting on approximately 5,000 megawatts of new capacity resources currently lodged in the PJM interconnection queue.
Wait, 5,000 megawatts in PJM alone?
Just in PJM.
We are talking about the equivalent output of 5 full-scale nuclear reactors, just waiting for regulatory clearance.
Yep. A combination of nuclear uprates, new natural gas generation, and utility-scale battery storage.
But this brings us to the primary friction point of the entire earnings call. Because you have Constellation holding the supply.
Right.
You have hyperscalers desperate with the demand. But the middleman, the grid operators and regulators are basically choking the throughput.
Yeah, PJM, which coordinates the wholesale market across 13 states, is the critical bottleneck here.
So what's the regulatory reality on the ground?
Well, PJM is currently attempting to force through a market-based solution for this unprecedented large load customer growth. They are fast-tracking a framework proposal to submit to the Federal Energy Regulatory Commission, FERC, by June.
Which is very soon.
During the call, Dominguez sounded genuinely taken aback by the pace, admitting this is moving faster than we had hoped.
Wow.
Yeah, in the context of regional transmission organizations, seeing a fundamental market redesign executed in months is virtually unheard of.
But the uncertainty of that pending FERC submission is really fracturing the demand side, isn't it?
Oh, completely.
The Q&A segment revealed a very stark bifurcation in how these tech clients are behaving.
Yeah, some hyperscalers have completely paused negotiations.
Right. They are refusing to lock in these massive 15-year power purchase agreements until they actually see the final tariff structures from PJM.
Which makes sense. But conversely, other clients are so constrained by their compute deficits that they are signing bilateral contracts right now.
Just eating the risk.
Exactly, absorbing the unknown regulatory risk just to guarantee their place in line for the physical electrons.
But the regulatory anxiety isn't just limited to the PJM interconnect. The analysts also drilled into the forward curves in the ERCOT market down in Texas.
Yeah, there's a glaring weakness in the pricing of forward power contracts for the 2028 and 2029 delivery years.
Right. The market makers are essentially pricing in a surplus or at least a moderation of demand, which seems wildly out of step with the macro narrative of a data center supercycle migrating to Texas.
Management pushed back aggressively on those forward curves. They view the 2028 and 2029 ERCOT market as vastly undervalued.
Because of the Q data.
Exactly. They cited the fact that there are over 400,000 megawatts of large load applications currently sitting in the ERCOT queue.
400,000.
Right. And even applying the most aggressive haircut to that pipeline, assuming, say, a 90% fallout rate, if just 10,000 to 30,000 megawatts of that load actually energizes, it is going to consume the entire reserve margin.
And put violent upward pressure on wholesale clearing prices.
Exactly, which leads directly into the deeper policy debate that dominated the Q&A, the PJM white paper.
Ah, yes, the white paper.
This document is attempting to resolve the escalating tension between optimizing the energy market versus the capacity market. As these massive AI loads come online, the grid requires more dispatchable generation to ensure reliability.
Naturally.
But there is a fierce debate over discriminatory treatment. Specifically, should a massive data center that requires 99.999% uptime be forced to shoulder a disproportionate share of the overarching system reliability costs?
Or should those costs be socialized across the entire rate base?
Exactly.
I mean, I have to push back here, or at least play devil's advocate on the cost allocation argument.
Let's hear it.
If these data centers demand so much power that grid operators literally have to rewrite the rules, aren't everyday consumers going to get footed with the bill?
It's the biggest concern.
Right. If grid operators are forced to overbuild transmission infrastructure and procure highly expensive capacity solely to satisfy the baseload requirements of a few trillion-dollar tech companies, the downstream effect on average commercial and residential tariffs could be severe.
Yeah, and this is the exact political friction point management is trying to navigate.
So what's their defense?
Management's defense against the cost shift argument relies heavily on the concept of dynamic load shaping.
Okay, what does that mean in plain English?
Their thesis is that integrating these hyperscaler loads actually drives up system utilization and lowers unit costs. You see, the grid is inherently inefficient. It must be built to withstand the single peak hour of demand during the hottest summer afternoon. For the other 8,759 hours of the year, a massive portion of the transmission and generation infrastructure sits underutilized, yet the fixed costs remain.
Right, so if you introduce a 500 megawatt data center that runs flat out 247, it drastically improves the load factor of the system.
Yes.
But, and this is a big but, that only works if the data center is willing to get out of the way during that one peak summer hour.
And management argued exactly that. These contracts are being structured with curtailment provisions.
Oh, wow. Really?
Yeah. The hyperscalers are agreeing to drop their load off the grid either by throttling their compute or switching to massive on-site backup generation during grid emergencies.
Okay, so that allows them to soak up the excess generation most of the year without contributing to the peak capacity requirement.
Exactly. It is an elegant theoretical model, turning the largest consumers of power into synthetic grid assets.
That makes a lot of sense.
But, to actually execute on this, Constellation cannot rely solely on legacy assets. They are deploying significant capital into new hardware.
Well, here's where it gets really interesting. Because we've talked about the financial concepts and the regulations, but let's look at the actual concrete, steel, and silicon being deployed.
Let's do it.
The Calpine acquisition was heavily touted for its retail and margins benefits, right? Bringing in roughly 275 million megawatt hours of electricity and 800 billion cubic feet of natural gas across 40 states.
Massive scale.
Huge. But the call highlighted that Calpine wasn't just financial. It also injected vital physical development capabilities into Constellation's pipeline.
And we saw the immediate realization of those development capabilities this quarter with 2 major physical plant deliveries.
Right, let's talk about those. First, they brought the Pastoria solar project online in California. This is a 105 megawatt solar array, but its real value proposition is entirely tied to its co-location with an existing 750 megawatt combined cycle gas plant.
Which is such a smart play.
It really is. This hybrid integration allows them to blend intermittent solar with firm gas dispatch to provide a tailored, lower carbon product.
Specifically designed to help the California Department of Water Resources meet their 2035 carbon neutrality mandates.
Exactly.
If we connect this to the bigger picture, the Pastoria project exemplifies the philosophy of a modern energy grid.
Right. It's not just about one fuel source.
No, you cannot simply retire dispatchable thermal assets and replace them gigawatt for gigawatt with solar. The grid requires the inertia and the frequency regulation provided by the spinning mass of a combined cycle turbine.
Yeah, the physics of the grid demand it.
By co-locating the solar, they optimize the interconnection limits of that specific node. It allows them to push maximum zero-carbon energy during the day while utilizing the gas plant to bridge the evening ramp when the solar generation collapses, but system demand peaks.
And halfway across the country, they executed a purely dispatchable play. They brought the Pin Oak Creek natural gas peaking facility online in Texas, adding 460 megawatts of capacity.
Entirely different operational profile from Pastoria.
Completely. Pin Oak Creek is not designed to run continuously. It is built for raw, immediate response. When ERCOT frequency drops, because, say, a cold front knocks out wind generation,
right,
this peaking facility is designed to fire from a cold state to full load in a matter of minutes, capturing the extreme pricing volatility that basically defines the ERCOT market.
The strategy is aggressively multifaceted. And we also saw this in the regulatory maneuvering surrounding the Crane asset.
Oh man, this was a highly technical point raised during the Q&A, but so important.
It really is. Constellation is currently pushing FERC to authorize the transfer of capacity interconnection rights, or CIRs, from their Eddystone plant directly to the Crane facility.
The CIR transfer is basically a masterclass in extracting value from regulatory frameworks.
Explain that for the listener.
So, capacity interconnection rights represent the physical authorization to inject a specific amount of power into the transmission grid at a specific node, right? Without violating thermal or voltage limit. Well, the Eddystone plant is currently operating under a unique energy-only mandate dictated by the Department of Energy, meaning those specific capacity rights were just sitting dormant, generating zero revenue.
Just wasted potential.
Exactly. So by attempting to legally port those CIRs over to the Crane facility, they are effectively unlocking full capacity credit revenues for Crane by 2027. And they get to do it without having to fund the massive network upgrades usually required to secure new interconnection rights.
It highlights a ruthless efficiency in how they view their asset base. And this optimization extends to their crown jewels, right? The nuclear fleet.
The uprates.
Management detailed ongoing capital deployments into nuclear uprates, specifically targeting the Byron and Braidwood facilities.
And an uprate, just to be clear, involves physically re-engineering the secondary side of the nuclear plant.
Upgrading high-pressure turbines, replacing feed water heaters, modifying the generator stators.
Right, all to extract more thermal efficiency and megawatt output from the exact same existing reactor core.
However, management was very clear on the timeline here. While the capital is being deployed right now, the actual earnings per share accretion from those Byron and Braidwood uprates won't hit the income statement until 2030 at the earliest.
Yeah, the engineering lead times and the Nuclear Regulatory Commission approval processes for anything nuclear are incredibly protracted.
Which brings us to the capital allocation strategy, because building all this hardware requires a monumental amount of capital.
It does. Luckily, Constellation is generating cash at a historic rate.
Yeah, this is perhaps the most compelling part of this transcript. To fund these uprates, build out the Pin Oak Creek peakers, and execute these powered land substations requires immense liquidity.
And the CFO laid out eye-popping numbers. For the near term, 2026 and 2027, they're projecting $8.4 billion in free cash flow prior to growth investments.
But the true inflection point arrives in the 2028 and 2029 window.
Yeah, hold on to your hats for this one.
For those 2 years, they're guiding a free cash flow explosion up to between $11.5 billion and $13 billion.
We are looking at a potential 45% step up in cash generation.
A 45% increase based on the forward pricing curves and the integration of the acquired retail margins.
So the immediate question for any corporate board sitting on a projected $13 billion is deployment discipline.
Right. What do you do with it?
Well, Constellation didn't wait around. They authorized a $5 billion share buyback program and have already executed on it, deploying $335 million in the quarter to retire roughly 1.2 million shares.
And this aggressive return of capital sparked a very strategic line of questioning from analysts regarding the Calpine shareholder lockup.
This was the juiciest piece of Wall Street mechanics from the Q&A. To finance the Calpine acquisition, Constellation issued 50 million shares of stock to the legacy Calpine owners.
Right.
But those shares are subject to a staggered lockup agreement to prevent a massive supply shock to the market. So 25 million of those shares will unlock and become freely tradable in June of 2026.
And the remaining 25 million hit the market in June of 2027. The analysts were basically probing to see if Constellation had any forward insight into whether those legacy owners planned to liquidate those 25 million shares on day one.
And Shane Smith maintained a strict firewall. He refused to speculate on the intent of the legacy owners.
Naturally.
However, he specifically linked the $5 billion buyback authorization to those unlocked dates, stating it provides the company with flexibility.
So what does this all mean?
Well, the subtext is remarkably clear. If the legacy Calpine owners attempt to dump a 25 million share block on the open market, the resulting supply glut would naturally depress the stock price.
Right.
Constellation is publicly signaling that they are sitting on billions in dry powder. If the stock gets dislocated due to that specific technical selling pressure, the company will step in, act as the buyer of last resort, absorb that supply, and retire the shares at a compressed multiple.
It is a highly engineered defense of their equity valuation.
It is. But I have to ask the obvious question. If they have $13 billion in cash, why buy back stock instead of building more power plants to feed the AI beast?
Which forces a deeper analysis of their internal hurdle rates. When you have hyperscalers demanding gigawatts of power, the instinct is to direct every available dollar into capital expenditures to build new generation.
Right.
But management emphasized a rigorous, returns-based discipline. They demand double-digit unlevered returns on any new physical asset development.
Okay, so they're weighing the marginal return of pouring concrete against the financial return of retiring their own equity.
Exactly. Management explicitly stated they view the current stock price as undervalued relative to their long-term growth trajectory.
And they are anchoring this confidence on a base earnings growth rate projected to exceed 20% through 2029.
And the cornerstone of that sustained growth isn't just market pricing. It is the structural support of the nuclear production tax credit, the PTC.
Right, established under the Inflation Reduction Act.
It fundamentally alters the risk profile of their baseload fleet. It acts as a revenue floor. If wholesale power prices collapse, the PTC ensures the nuclear plants remain economically viable.
And more importantly, that PTC floor price is indexed to inflation.
That is the key. As macroeconomic pressures increase the cost of labor and materials, the baseline value of their zero carbon generation automatically scales up,
providing a highly unusual federally backed inflation hedge right at the core of their business model.
Exactly.
So, synthesizing an hour of dense corporate strategy into tangible takeaways for you, the listener, what we're looking at is a company that is no longer just reacting to the energy transition.
They are actively shaping it.
Right, as evidenced by Barron's recently naming them the #1 most sustainable U.S. company out of the 1,000 largest publicly traded companies.
It's a testament to how effectively they have positioned nuclear power as the premier, indispensable asset class for the green transition.
The fundamental takeaway for you, whether you are an investor looking at that 10% rolling EPS growth or just a citizen paying a utility bill, is that the era of dumb bum power is over.
Oh, long over.
The technology sector has realized that they cannot achieve their AI processing goals relying on a legacy public grid governed by localized weather patterns and intermittent renewables.
They require the exact intersection of firm, zero-carbon baseload and rapid response thermal peaking that Constellation has aggregated.
We're entering an era of bespoke, highly engineered power agreements, where data centers might physically relocate their computing jobs across the country in real time just to chase cheaper available megawatts.
And the next 6 to 12 months are going to be defined by regulatory clarity. When PJM finalizes their market framework and submits to FERC, it will likely be the catalyst that breaks the logjam of paused negotiations.
We are going to see billions of dollars in sidelined infrastructure capital suddenly aggressively deployed into physical data center construction.
Yeah, but this raises an important question that extends far beyond a quarterly earnings print.
Let's hear it.
As we watch these powered land agreements proliferate, and as tech giants secure exclusive behind-the-meter access to our most reliable nuclear infrastructure, are we structurally bifurcating the American power grid?
Wow.
We may be rapidly accelerating toward a reality where the most robust, hyper-engineered generation assets are entirely walled off to power artificial intelligence.
While the broader public residential base is left reliant on a more fragile, weather-dependent legacy transmission system. That is a critical paradigm shift in how we value and distribute fundamental infrastructure. The rules are being rewritten in real time, behind the meter, and in the dockets of FERC and PJM. Thank you for taking this deep dive with us today and guiding us through this dense financial landscape.
My pleasure.
To everyone listening, keep questioning the world around you, examine the structural shifts behind the headline numbers, and we will catch you on the next one.